Warning: the views expressed in this video are controversial and may not be considered environmentally or socially responsible investing to some audiences. Viewer discretion is advised.
Hi, my name is Elliot Gu. In the next few minutes, I'm going to show you an urgent video presentation I've recorded concerning the recent jump in oil prices and energy stocks. I'll explain why I believe OPEC is losing control of the global oil market this summer, why the resulting squeeze will send crude oil to $100 a barrel or even higher with dangerous consequences for investors and the global economy, and some of the steps I'm recommending right now to potentially take advantage of the shifts currently underway in global commodity markets. You see, I've spent the last 19 years publishing financial research services for individual and institutional investors regarding commodity prices, energy stocks, and related investments. In 2006, I co-authored this book published by Prentice Hall titled The Silk Road to Riches, where I predicted the big rally in oil, natural gas, and energy stocks caused by booming demand from emerging markets like China and India. And I'm certainly no stranger to controversy. A little over 4 years ago, with oil still near $100 a barrel, some so-called experts laughed when I published a series of articles and reports predicting a collapse in oil prices to below $30 a barrel. And when I cautioned that Saudi Arabia actually wanted oil prices to fall to help squeeze U.S. shale production out of the global market.
Over the past few years, I've even received hate mail from some for advising sells in popular energy stocks such as Deepwater Driller Seadrill, Prop and Sand Miner Emerge Energy Services, and High Yield MLP Energy Transfer Partners. Those critics were silenced when these stocks subsequently collapsed, slashed their dividends, and in the case of Seadrill, filed for bankruptcy. However, before I go any further, I must warn you. Some of the trends and forecasts I'm going to make today as part of this presentation may be even more controversial than that sub $30 a barrel oil call I made just a few years ago. That's because what I'm about to tell you is probably the exact opposite of what you've been hearing in the mainstream and financial media. Listen, I have no desire to offend anyone, so let me be a bit more blunt. If you believe that Tesla, that's the electric car company, should properly be valued at $61.6 billion, that's more than General Motors and at nearly twice the market value of Ford. If you believe that electric vehicles will displace conventional internal combustion engines in the next 5 or 10 years, and that we don't need more crude oil or new oil pipelines in the United States, or if you believe in peak oil, and by that I mean a near-term peak in global oil demand, then you're probably not going to want to hear or see what I'm about to show you. So I suggest you just click away from this website right now, as this presentation probably just isn't a good fit for you. You see, this presentation is not politically motivated. However, some might not find it politically correct. I have no interest in wading into any debate about climate change or socially responsible investing. As I'll prove to you in just a moment, this presentation is about facts, economic realities, and fateful decisions that were made many years ago by governments and companies all over the world. The truth is that nothing can stop the trends underway in the global oil market right now. Not Saudi Arabia and not the rest of OPEC, not President Trump, not Russia, not China, India, or Brazil, not Elon Musk at Tesla or the latest technology out of Silicon Valley, and certainly not the U.S. Congress. However, if you're still with me, I urge you to keep listening through to the end, as I believe this could be one of the most important and profitable presentations you hear this year. You see, the truth is that for decades, there's been a single thin barrier separating the global economy from a devastating super spike in crude oil prices. In 2008, when this barrier last strained and creaked, Brent oil prices soared to around $150 a barrel, helping make the 2007 to 2009 Great Recession even more painful and damaging than it otherwise would have been. However, here's what really has me worried. So far in 2018, this barrier has weakened by about 30%, and our research suggests it could completely fail this summer, driving oil prices to $100 a barrel or higher by early next year. Just a few days ago, I hosted an online presentation for a small group of investors where I explained in the simplest terms possible the trends currently underway in global energy markets. It's far too important to just hide behind a paywall. So today, as part of this presentation, and only through this website, I'm going to release a portion of this video to the public free of charge. I promise I won't waste your time. Keep watching this presentation through to the end, and you'll also discover some of the specific and very time-sensitive profit steps I'm recommending right now. All of these powerful trends and cycles are coming to a head this summer. So without any further introduction, here's my latest video presentation on global energy markets. This first slide here is actually a tweet from President Trump, and it was on the 30th of June, and it caused quite a stir in the mainstream media and in the financial media. I actually do believe, as this tweet suggests, that Saudi Arabia actually would like lower oil prices right now. The Kingdom of Saudi Arabia does not want oil prices to get up to $80 or $90 a barrel. They don't want the price of Brent crude oil to get up to $100 a barrel again, certainly. While that would mean more money for them, more money in their pockets, Saudi Arabia is very, very sensitive to demand for oil. And their feeling has been, and a lot of their comments surround the idea, that $80 or $90 a barrel crude oil is probably going to destroy demand for oil. They really don't want oil prices to be that high because they think it's going to negatively impact demand, and ultimately that's going to be a longer-term problem for them. So it's not so much about them deciding that they want to, help out the United States. It is, if you will, enlightened self-interest on the part of Saudi Arabia to want lower oil prices than where they've gotten up to very recently. So I do think that Saudi Arabia wants to push down the price of oil, or at least keep it from rising too far too fast this year. However, the question in my mind is, are they able to push down the price of oil even if they wanted to? And that's where this 2 million barrel a day figure referenced on that tweet comes into play. And this chart is actually a chart we created of what's called OPEC's spare capacity. Many of you may have heard of the term spare capacity, but what it is that it's basically mothballed oil wells and mothballed oil fields. So in other words, if some OPEC members, mainly in OPEC, produce less oil than they theoretically could. So in other words, Saudi Arabia could produce around 12.5 million barrels of oil a day if it wanted to. But it has never produced that much oil per day. And so what they really are doing is they're keeping certain wells shut in. They're not producing, at least not at the full flow rate, on some of their wells, existing wells in fields. However, if they wanted to, within 1 month, they could bring on an additional, right now, they could bring on an additional 2 million barrels a day of extra oil production. And that is actually, I believe, what was referenced in that tweet from President Trump I showed you on the prior slide. He talks about 2 million barrels a day. Well, Saudi Arabia's spare capacity is about 2.05 million barrels of oil a day. Technically speaking, spare capacity refers to oil production that a country can bring on stream within 30 days and sustain. In other words, they can sustain that production rate for at least 3 months, 90 days. And in the case of Saudi Arabia, it's a little over 2 million barrels a day. For the last few decades, Saudi Arabia has always sought to maintain between 1.5 and 2 million barrels a day of spare capacity. This, again, is mothballed oil fields. This is production, this is supply of oil. It's very reliable supply of oil that Saudi Arabia could bring to bear should it need to or want to for any reason. You'll see some other countries on this chart, and these are OPEC countries. And Iraq, for example, estimates that they have around 400,000 barrels a day of spare capacity. Honestly, that's not very reliable. Some of that spare capacity is in northern Iraq, which is not even controlled by the Iraqi government. And Iraq is very unreliable producer right now due to lingering issues with many of their fields. The United Arab Emirates there, they have around the same amount. That is actually pretty reliable. UAE could bring about 300,000 to 400,000 barrels of extra oil production per day on stream. Nigeria, they claim around 300,000 barrels a day of spare capacity. That's also not very reliable. As many of you probably have heard, Nigeria has a lot of problems with sort of guerrilla groups that are operating in the Niger Delta that actually sabotage oil infrastructure like pipelines in that part of Nigeria, which means that they're producing as much as they possibly can right now. And the reason they're not producing to their full capacity is simply because there's been a lot of damage done to their oil infrastructure from these guerrilla groups over the last few years. And Kuwait is another country with around 250 or 300,000 barrels a day of spare capacity. And that, again, that is fairly reliable. Kuwait is a reliable producer. They really have a history of keeping that spare capacity online. When they want to bring it to bear, they can actually produce more oil. When the government decides in Kuwait they want to produce more oil, historically they've been able to do so. Now, if you add up all these numbers, all these spare capacity numbers across OPEC, you come up with spare capacity of around 3.4 million barrels a day. Global oil consumption is right around 100 million barrels of oil a day by the end of this year anyway. So it's a little over 3% of global supply is being held back, right? So in other words, 3% of total global demand for oil is being held as spare capacity. Now, the way of thinking about this is kind of a supply cushion, right? This is the world's supply cushion, this spare capacity. If something bad happens, such as, a few years ago, the Suez Canal through Egypt was shut down temporarily to tanker traffic, and tanker traffic transit through that area was interrupted, and normally that might cause the price of oil to really spike. But one of the things that kept oil from spiking was that Saudi Arabia came out and said, okay, we will supply additional barrels to the market as needed to keep the price of oil from going too high. So that spare capacity is kind of like an insurance policy for the global oil market. And if you really think about it, that spare capacity is the only thing that keeps the world keeps the global economy sheltered from, $100 barrel plus oil. Because this is the only real capacity we have in the world to offset supply shocks. As I said, technically the headline number is 3.4 million barrels a day. But as I said, really Saudi Arabia, the UAE, the United Arab Emirates, and Kuwait, those three countries are really the only countries in the world which have reliable spare capacity right now. All these other countries' spare capacity you see on the chart is dubious at best and downright incorrect in my view when it comes to names like Libya. Libya, obviously, their oil production is governed by security issues within the country itself, and the fact that, different halves of the country are actually run by separate, semi-warring governments. I mean, the country's still more or less in a civil war scenario right now. So really the entire global economy, the entire global oil market, and the entire global economy kind of rests on this supply cushion, this OPEC spare capacity supply cushion. As I said, 60% of it at best is in Saudi Arabia, and that's the 2 million barrels a day that you see on this slide right here. So my point is that theoretically, Saudi Arabia could increase their oil production by around 2 million barrels a day, as that tweet suggested. If they did so, though, I believe that the price of oil would go dramatically higher, not lower. Although that would involve pumping additional supply into the world market for oil, it would also shrink OPEC's spare capacity from 3.4 million barrels a day all the way down to around 1.4 million barrels a day, which is less than 2% of global consumption of oil. To put that into perspective, back in 2008, when oil prices went parabolic, they went parabolic not because OPEC was cutting production. OPEC was actually increasing production and putting more supply in the market in the first half of 2008. OPEC prices went parabolic because the market became concerned that there wasn't enough spare capacity left in the global oil market. At the highs for oil back in 2008, again, close to 150 bucks a barrel, the spare capacity in the world was around 2.5% 2.5% or so of global oil consumption. Today, we're a little over 3%. However, if OPEC were to add additional barrels to the global market, if Saudi Arabia were to dip into that 2 million barrels a day of spare capacity, we would very quickly see a scenario where global spare capacity as a percentage of global demand would actually be tighter today than it was back in 2008 when oil prices were close to double where they're trading today. So I think this is the this is the biggest concern. It's not whether OPEC is going to decide to add some more barrels to the world market. They already are, in fact, as I'll show you in a minute. It's that when they do so, their credibility in terms of controlling prices, controlling the rise in prices, actually goes down because they don't have additional spare capacity with which to flood the market with oil and push prices back down. So again, I mean, the important thing here isn't what OPEC's going to do. It's whether OPEC can maintain control of the oil market this summer or not. And I believe there's a risk they won't be able to, and that we could see prices closer to $100 a barrel by early next year. Here's a chart of Saudi Arabia's overall oil production, which in the month of May was a little over 10 million barrels a day. They have said that this month, in July, they're planned to produce around 10.8 million barrels a day. The reason I took this slide back to the late 1990s is to show you that 10.8 million barrels a day of Saudi production would be a record high for oil production from Saudi Arabia. The previous high was set in September 2016, but Saudi Arabia is now producing, according to their own government, which has a history of being accurate about this, they're producing more oil today than they ever have, than Saudi Arabia ever has in its entire history of being an oil producer. So that's a pretty dramatic number. And we do think that one of the reasons that they're trying to do that is, again, they're worried that oil prices have gone too high and that all these supply outages from places like Libya and Venezuela and Mexico that I'll talk about in a minute, even Canada and also the United States, which I'll talk about in a minute, are pushing up the price of oil too high. They're artificially restricting the supply of oil, and Saudi Arabia wants to offset that. But again, the question is, if I flip back to this slide here, they only have a little over 2 million barrels a day of spare capacity. And that's based on production of around 10 million barrels a day back in May. If Saudi Arabia increased their production to 10.8 million barrels a day, as they claim to have this month, their spare capacity is only 1.2 million barrels a day. So you can already see that Saudi Arabian oil production and Saudi Arabia's spare capacity is getting to the lowest levels we've seen almost in their entire history as an oil producer. So the oil market's very tight because even though OPEC is producing more oil, spare capacity is getting to the tightest levels we've seen since the first half of 2008 when oil prices soared up over $150 a barrel rather. Here's a chart. Let's talk about some of the production outages that are going on around the world right now. This is a chart of Mexican oil production. Back in the 2004-2005 period, Mexico was producing around 3.5 million barrels a day. This year, they're producing less than 2 million barrels of oil a day. And oil production is plummeting. And the main reason for this is that a lot of their fields, in particular the Cantarell oil field, which is an offshore, a shallow water offshore oil field in Mexico, are very mature. And as conventional oil fields mature, you begin to see declining production as the geologic pressure in the field begins to drop. Now, Mexico, over the past couple of years, has been making an effort to reverse this. And one of the ways that they have done that is that they're trying to encourage foreign oil companies like Chevron, for example, to partner with their national oil company, which is called Pemex, to actually develop some deep water fields they have in the Gulf of Mexico. Now, these fields are not located far away from U.S. deep water fields, which are quite prolific fields. And so Mexico, their biggest hope to increase oil production over the next 5 years or so is to develop these offshore oil fields. To encourage foreign companies to come in and provide the capital and expertise needed to develop these fields, Mexico actually had to change their constitution, because their constitution prohibited foreign oil companies from owning stakes in Mexican oil projects directly. And so they changed their constitution to allow foreign ownership and foreign participation in Mexican oil fields, because they needed the capital and expertise. But as many of you know, probably know, last weekend actually, on the 1st of July, Mexico elected a new president. And President Obrador, he'll actually be sworn in on December 1st of this year. He is a left-wing candidate, and he said that he wants to actually renegotiate the deals that the prior Mexican government had negotiated with a lot of large international, mainly American oil companies. So there's a chance that he could actually change the existing contracts on those deepwater projects. And I believe that's going to slow investment in Mexican oil production and Mexican deepwater fields. Pemex, their national oil company, certainly can't do this on their own. I think you're going to look at more at even faster oil production declines out of Mexico over the next few years. Already, just since 2014 or so, Mexican oil production is down more than 500,000 barrels a day. It's declining at a rate of around 250,000 barrels a day or so a year at best right now. So that's even more oil coming off the world market that OPEC would have to dip into its own spare capacity to offset. Venezuela, most of you are probably aware of the very sad situation going on in Venezuela. We have a socialist government, Nicolas Maduro, and inflation rate there over 15,000% in the last month alone. This is hyperinflation. This is the kind of thing we saw back in Germany, back in the interwar years, and it's the kind of thing we saw from Zimbabwe not long ago. The economy is collapsing. There have been reports that the biggest problem facing Venezuelan's national petroleum company right now is the fact that a lot of their workers, their oil field workers, just aren't able to eat enough. So they're literally fainting on the job. And they're having all their senior staff have left if they can. Their experienced petrogeologists used to be kind of the envy of Latin America in terms of their geologists and the quality of their oil workers. A lot of them are actually educated here in the United States. A lot of those people, though, have left Venezuela because of security concerns, economic concerns, to take jobs in the United States. So there's been kind of a brain drain. Venezuelan oil production is plummeting. It was close to 2.5 million barrels a day, actually around 2.3 million barrels a day. As recently as early 2016, we're now around 1.4 million barrels a day. I think that Venezuelan oil production could drop under 1 million barrels a day by early next year. And that's yet another 500,000 barrels or so off the global oil market over just the next 6 months or so. Libya, you may have heard about Libya over the last few weeks. Libya went through a civil war a few years ago. Prior to the civil war, they were producing more than 2 million barrels of oil a day. During the civil war, production dropped down to 200,000 barrels a day or so. You can see that in late 2013, early 2014. And then since the end of 2016, oil production out of Libya has actually recovered from around 200,000 to 300,000 barrels a day all the way up to right around 1 million barrels of oil a day. And a lot of that's been the result of a single general in Libya, General Haftar, who seized control of a lot of Libya's oil terminals, export terminals, and oil fields. And he stabilized things by taking control of these oil fields and oil terminals from these sort of rebel groups and guerrilla groups that were in control of them previously. That allowed them to repair some of their oil infrastructure, and that's what facilitated that recovery in oil production over the last 18 months or so. The problem is that more recently, General Haftar actually turned over some of the fields and terminals in eastern Libya to the government in eastern Libya, which is headquartered in Benghazi. That is not internationally recognized. So that government isn't actually authorized
to export oil from Venezuela, from Libya. So production more recently, and this is as of June, the end of June, has fallen from 1 million barrels a day to a little under 700,000 barrels a day. So that's 300,000 barrels a day off the global oil market. I've seen some more recent estimates of Libyan oil production, and the belief is that it has fallen as far as 400,000 barrels a day right now. And I don't see a chance that it's going to recover back to even 1 million barrels of oil a day over the next few months. So that's another 500, 600,000 barrels a day off the global oil market. And again, this is oil which OPEC, the rest of OPEC, because Libya is part of OPEC, they simply cannot replace that. They don't have enough spare capacity to offset that, offset Venezuela, offset Mexico as well. Here's another one, West Africa, Angola. Angola produces the vast majority of their oil from deep water fields located off the western coast or offshore oil fields. Most of them are deep water. And back in the early 2000s, when their civil war ended, their civil war went on for decades, and it was very, very bloody. But back in the middle 2000s, 2004, 2005, as the war came to an end, they actually did attract an awful lot of investment from foreign oil companies, including Total of France, including ExxonMobil, and others. And their oil production soared, and it got up well over 2 million barrels of oil a day. The problem with Angolan oil fields is that, as I said, they're deep water oil fields, and the underground pressure, the geologic pressure in those fields is very high. The positive side of that is that when you first drill a well in a very high pressure field, your rate of production is super high. The downside of that is that as the field ages and that natural geologic pressure begins to dissipate, the decline rate, the rate at which your production from those fields declines, is very rapid. So the decline rate for Angolan oil fields is around 15 to 18% per year. The global average is more like 4 to 6%. So Angolan oil fields rather have about triple the decline rate to your average global oil field around the world. So the problem is that after those initial fields were developed, since 2014, very few companies have put any money into Angola. There's not been a whole lot of exploration and development of new fields. There hasn't been investment in new projects, for the simple reason that oil prices have been falling and the big international oil companies have been pulling back on their capital spending budgets. By my reckoning, the decline in global oil spending and spending on exploration and production has been almost $800 billion since 2014 alone. That's a pretty big black hole of a decline in spending. As a result, here you see, this is a chart showing the total amount of oil that the Angolan oil company is loading onto tankers for export. It's fallen from around 1.9 million barrels a day in late 2015 to a 20-year low of around 1.35 million barrels a day as of August of this summer is what they're scheduling to export. So Angolan oil exports and production are plummeting, and there's only a limited scope to reverse that because, again, producers, in order for producers to reverse this decline, they would need to have more investment flowing into the Angolan oil industry, into developing new projects and new fields to offset the decline from those existing maturing projects. There's only one new oil field due to start production in Angola over the next 2 years, and that's Kaombo, which is a Total-led project. And that's only about a 250,000 barrel a day field. So we think Angolan oil production is going to continue to fall relatively sharply over the next 18 months and probably longer than that. So that's a kind of a little brief look at a lot of the oil outages and production we've seen all around the world. I'd also mention, of course, Iran, new sanctions on Iran, or the reimposition of sanctions on Iranian production will likely result in further declines in their output and exports. I'd also mention Canada. An unscheduled outage at an oil sands production facility in Canada has resulted in about 300,000 or 400,000 barrels a day coming off the coming out of Canadian production this month in July. I don't think they're going to restart that project until the end of the month, maybe early August. So Canadian oil production even has been disrupted. And I want to move from that global look to right back here at home in the United States. And this is maybe from a short to intermediate term basis, this may be the most important chart I'm going to show you today. So I can't exaggerate the importance of this enough, I don't think. This is a chart of 3 key oil price benchmarks here in the US. In gray, that benchmark is LLS, which stands for Light Louisiana Sweet Crude Oil. It's a light sweet crude oil, which means that it's low in sulfur content, relatively easy to refine. It's a very similar grade of crude oil to Brent crude oil, which is an international oil benchmark. And crucially, this particular grade of crude oil is priced for delivery on the Louisiana Gulf Coast. So right on one of the key refining centers in the United States on the Louisiana Gulf Coast. That blue line that you see there is a benchmark of crude oil called West Texas Intermediate. West Texas Intermediate is priced for delivery in Cushing, Oklahoma. Cushing, Oklahoma is a very small city, actually. It's a key pipeline hub in the state of Oklahoma. It's located in the eastern part of Oklahoma. This also has a distinction of being the official delivery point for U.S. traded oil futures. So when you turn on, financial television, or you open the Wall Street Journal or whatever, and you see the price of oil quoted, you'll often see the price of West Texas Intermediate crude oil futures, WTI oil futures, and that's priced for delivery in Cushing, Oklahoma. The third line you see on this chart, the sort of burnt orange color, I guess, is the same type of oil. It's the same grade of crude oil, West Texas Intermediate, except instead of being priced for delivery in Cushing, Oklahoma, it's priced for delivery in West Texas, in Midland, Texas, which is in the Permian Basin area of Texas. And as you can see, the price differences, these 3 grades of crude oil have historically tracked one another quite well. That was the case from the middle of last summer, certainly up until January or February of this year. But since that time, since the end of February, we've seen a big divergence in the prices of crude oil even though these 3 grades of crude oil are very similar in terms of quality, they're very different. There's a very big difference in their prices. LLS is trading, this chart was as of the end of last month, but the LLS was trading up over 75, it was trading around $77 a barrel at the end of last month. Cushing crude oil, which is West Texas Intermediate, at the same time was trading around $74 a barrel. And Midland crude oil, the same exact crude oil, was trading in the low 60s per barrel. So these are almost record-wide differentials between oil traded in different parts of the United States. The reason for this, it's all about infrastructure, okay? So Permian Basin is the lowest cost shale oil field in the United States. It's the cheapest to produce, and it's extremely prolific. But at the same time, there simply is not enough pipeline capacity to move oil out of West Texas and New Mexico, where the Permian Basin is, and where Midland oil is priced, to either Cushing in Oklahoma, which is only 500 miles away by truck, or to the U.S. Gulf Coast, either places like Houston or Corpus Christi, or over in Louisiana, where it can be refined or exported. So if you have oil and you're producing oil out of the Permian Basin, it's worth $75 a barrel plus if you can get it to the Gulf Coast. If you can't, you're selling it for $60 a barrel. And this is all, again, due to a lack of sufficient pipeline capacity out of West Texas and New Mexico. And the thing is, this is not going to get any better until the end of next year. And the reason it's not going to get any better is because there are some new pipelines due to come on stream in the second half of 2019. In particular, the Cactus II pipeline. A lot of these pipelines are aimed at moving oil from the Permian Basin of West Texas and New Mexico to Corpus Christi, Texas, where there is significant oil export capacity. In other words, companies can load the oil onto a tanker and export it and achieve much higher prices, more Brent-like crude oil prices. But that's not going to be ready until the end of next year or early in 2020. These pipeline projects have a nasty tendency, the timelines for their completion have a nasty tendency to slip. So the problem with this is that it's limiting the potential for U.S. oil production growth to offset all these international project delays, declines, natural decline rates, political strife, etc., that are causing all these interruptions in global supply.
So there you have it. Don't worry about OPEC controlling the oil market. That's just what cartels do, and it's certainly what OPEC has done throughout its 58-year history. Instead, worry when OPEC loses control. And that's exactly what's happening this summer as Saudi Arabia and the rest of the OPEC Plus group simply don't have enough spare production capacity to offset supply disruptions, including the collapse of 21st century socialism and Venezuela's ongoing economic, humanitarian, and security crisis. Aging oil fields in Angola that have pushed production to more than decade lows. Libyan production collapsing 500,000 barrels a day since May alone. Plummeting output from Mexico and the uncertain fate of the nation's energy industry under its new left-leaning president Obrador. And now a long brewing shortage of pipeline capacity in the U.S. that's slowing shale development, particularly in the vast Permian Basin of West Texas and the state of New Mexico. Of course, the most important thing isn't what's happening in oil markets right now, but what you can do to protect your portfolio and potentially even profit from the changes underway. And that brings me to a few simple profit steps I'm recommending right now. Profit step number 1, buy under-the-radar Master Limited Partnerships. Master Limited Partnerships, or MLPs, are a high-yield, tax-advantaged group of companies that trade on the major exchanges just like any other stock. Close to 90% of all MLPs are involved in the midstream energy business, owning assets such as oil pipelines, natural gas processing facilities, and oil storage terminals. A little earlier on in this presentation, I told you about the desperate situation in the Permian Basin of West Texas and New Mexico these days. Specifically, there's just not enough pipeline capacity to move all the oil produced in the Permian to key refining infrastructure and export markets on the U.S. Gulf Coast. As a result, some producers in the Permian are selling their crude production at price discounts of $20 a barrel or more to the exact same oil priced on the Gulf Coast. MLPs are building the infrastructure needed to solve these bottlenecks, and some select names will be generating serious profits and distribution income for their holders over the next 2 to 3 years. I'm talking about tax-advantaged yields of 5%, 7%, or in some cases, even 10% and higher from the best positioned names. However, before I go any further, I must warn you that there are some very dangerous MLPs out there, and sadly, some of the most vulnerable names also happen to be the most widely held and the most popular investments. You see, a lot of investors I speak to buy MLPs through an exchange-traded fund, like the Alerian MLP ETF, under the symbol AMJ, and that ETF is actually down 4.7% over the past year. That's led to a popular delusion that MLPs have not performed well over the last year, and that's just an outright lie. The secret to investing in the group is this: you must look beyond the largest names in the industry and the major ETFs that track MLPs for the best yields and the best opportunities. In fact, in our view, the ETFs that track MLPs are actually terrible investments that are more about earning fees for their issuers than making money and generating steady income for investors like you and me. It's some of the largest MLPs that are actually the most vulnerable right now. Listen, while the industry benchmark Alerian MLP index is down nearly 5% over the past year, along with many of the popular ETFs tracking the group, we've been recommending one under-the-radar MLP that currently has a 7.5% yield that's actually up more than 55.6% over the same time frame. And if you're buying the most popular MLP ETFs, only a little over 1.05% of your money has been invested in this name, giving you almost zero exposure to one of the industry's best performing stocks. Another of our favorites offers a yield of 13% right now and has returned a solid 8.6% over the past 12 months. And this small MLP isn't even in any of the major ETFs tracking the industry. And one of our top recommendations right now offers a 5.1% yield, and we see upside of 30 to 50% over the coming 18 months as the company brings several new pipelines serving Permian Basin producers into service. Look, my colleague Roger Conrad and I just returned from the MLP Association's annual investor conference, where we had a chance to grill management teams from around 24 MLPs we follow. Following the conference, we met to compare notes, and we recorded our entire 3-hour conversation. I'd like to send you a transcript of that conversation, including all of our top recommendations in the MLP industry right now. And just as important, the transcript includes all you need to know about some MLPs we believe to be dangerous investments right now. Roger and I have been attending this conference for well over a decade, and our analysis of MLPs we speak to has long been one of the most popular and most sought-after reports we release every single year. Normally, it's available only to paid in full subscribers to our premium service, Energy and Income Advisor. However, today, and only through this website, I'd like to give you immediate access to this report with no strings attached, no risk or obligation. I'll show you how to get access in just a few moments. However, first, I promise to tell you about this. Profit step number 2, oil producers, what to buy and what to avoid. We track around 75 oil and natural gas producers. These are exploration production companies operating in North America alone. The 7 E&Ps we've recommended over the past year are up an average of 62.96%. The 7 worst performing names in our coverage universe, none of which we've recommended, are down 31.48% on average over the same time frame. In the 19 years I've covered this industry, I've never seen the gap between the winners and the losers in the energy industry wider than it is right now. So you might be wondering, how do you differentiate the E&Ps that will perform best from those that could lose you some serious cash, even if oil prices continue to move higher as we expect? Well, of course, there are many factors we look at and many different metrics to consider. However, one of the best we've found is called debt-adjusted production growth per share. You won't find this measure in any corporate press release. You won't find any software or service that allows you to screen for companies that rank well on this basis. Instead, you must calculate this measure by combing through years of financial statements and quarterly reports. However, I just published a detailed report in early June called What Drives Performance for E&P Companies. And I'd like to send you a copy of this report right now that's yours to keep. This report contains debt-adjusted production growth per share statistics for a list of 49 North American producers. And it explains exactly how we use this measure to identify the best placed producers in our coverage universe. Plus, this report also contains our top recommendations in the energy industry right now and some names to avoid that look vulnerable on this basis. To my knowledge, no one else offers this comprehensive list of E&P stocks ranked on this powerful metric. However, I urge you to hurry because some of the E&Ps we've identified are beginning to break higher, and I just don't know how much longer they're going to remain below our recommended buy prices. The best news is that this report is available risk-free for a limited time through this website, and if you accept my invitation today, I'd like to give you access immediately. Before I show you how to claim your copy with no risk or obligation, I really need to tell you about this. Profit step number 3, electric vehicles, hype, and reality. If you listen to the mainstream media and the financial media, you might think that the market for electric vehicles is absolutely booming. Or you might believe that the rise of electrics will soon render oil obsolete, and that the resulting peak demand for oil will result in a big decline in crude prices over the next few years. There's only one problem. The alleged rise of EVs is largely fake news. The market for such vehicles remains tiny, and it's shrinking, not growing. Let me explain. Car makers call EVs and hybrids alternative drivetrain technologies. In the US last year, total new car sales were around 17.1 million units, up from 15.5 million units in 2013, and that's an increase of around 10%. Pure electric sales have increased at a much faster pace than that, rising by more than 100% over the same time frame, about 10 times the pace of total U.S. car sales. However, there are two problems with this data. First, despite all the hype about new EV models, total sales in 2017 were just a little over 195,000 vehicles, and that's only about 1.14% of U.S. new car sales. And here's what's even worse. EVs are not attracting new buyers. You see, in 2013, pure EV sales were 97,193 units, and sales of hybrid cars, like Toyota's Prius model, were 495,530 units, and that adds up to total sales of these alternative drivetrain vehicles of 594,910 units. Last year, while sales of EVs jumped, sales of hybrids have plummeted by an even larger amount to just a little over 371,000. Total alternative drivetrain sales have fallen about 4.3% since 2013 to just 569,375 units. In percentage terms, that means that U.S. alternative drivetrain sales have fallen from about 3.8% of total car sales to just 3.3% since peaking in 2013. The most likely explanation is that consumers who purchased hybrids 4 or 5 years ago, they're now replacing those vehicles with electric vehicles. But the total market for alternative drivetrains is shrinking, not growing. I bet you haven't heard those statistics in the media amid all the hype about EVs. Listen, we believe there is a future for electric vehicles, and that ultimately they will grow to become dominant in the auto industry. It's just not going to happen in the next 5 years, and it's not going to happen in the next 10 years, and probably not even the next 15 years. However, there are some pretty surprising ways to invest in the EV market and in more modern, high-tech, and more fuel-efficient internal combustion automobiles. It's not about buying a money loser like Tesla, trading at nosebleed valuations and hoping for the best. And it's not about buying some overhyped play on lithium or even a new battery manufacturing technology. Instead, my colleague Roger and I have identified a handful of stocks that will benefit from the growth in electrics over the long haul, and from growth in newer, more fuel-efficient internal combustion engines in the short run. One of our favorites trades at a discount to the S&P 500, generated $4.7 billion in free cash flow last year, pays a 2.2% dividend yield, and has been buying back stock. Look, I don't have time in this short presentation to go through all of the truth about electric cars and all of our recommendations to play longer-term growth in this sector. However, I recently created a special premium report on electric vehicles I call Electric Vehicles: Hype and Reality, and I'd like to invite you to download a copy of this report today. In this report, I cut through all the hype and hyperbole about electric cars and recent internal combustion bans announced by several European countries, and I'll tell you exactly what we're recommending to play growth in EV technologies. And overhyped growth plays aren't the only stocks you're going to need to avoid over the next 18 months. And that brings me to this. Profit step number 4. Urgent income alert, our endangered dividends list. Look, in today's pay-nothing interest rate world, many investors have turned to dividend-paying stocks, or MLPs, to generate the income they need. Many investors I speak to look at income stocks as safe or at least somewhat defensive names to own amid broader market volatility. However, nothing falls faster than an income stock that cuts its dividend. Just consider that Genesis LP, a pipeline company, slumped 22.5% in just over a month after slashing its quarterly distribution last October. And Enbridge Energy Partners has plummeted more than 40% since announcing a cut to its quarterly payout back in January 2017. Both of these stocks fell so much after announcing cuts to their payouts, they wiped out years of accumulated distribution income in just a matter of a few days. The truth is, if you're like me, you're looking to generate income from your portfolio, and you simply can't afford to watch one of your income stocks cut its payout and wipe out 3 or 4 or more years worth of accumulated dividend and distribution income. That's why my colleague Roger Conrad created his endangered dividend list. Based on his proprietary cash flow risk model, developed over more than 30 years of research on income investing. It's a table of stocks Roger believes are at high risk of cutting their payouts and sinking their shareholders. And he updates his model and his endangered dividend list twice per month to make sure that you're never caught by surprise when one of your income bellwethers slashes its payout. I'm not exaggerating. If you're looking to generate income from energy stocks or MLPs, you need this list before you buy a single share of stock. It could save you from making a very dangerous investment in a high-yield stock that's about to cut its payout and sink your portfolio. I urge you to examine Roger's latest endangered dividends list, and we've decided to make it available to you risk-free through this letter. I'll show you how to get a copy in just a moment. However, first I promise to show you one more profit step we're recommending right now. Profit step number 5. Filling the $786.3 billion black hole. Over the past 4 years, amid slumping oil prices, most oil producers around the world have dramatically scaled back their spending on exploration and production. That's why the number of new oil fields discovered around the world plummeted to a 70-year low in 2016. And discoveries remain near that record low level last year as well. Our research confirms that the total spending shortfall is a cumulative $786.3 billion since 2014. Since major international oil projects take 3 to 5 years to move from final investment decision to oil production, this black hole of investment can only mean one thing: a dramatic decline in supply over the next few years. The good news is that we're beginning to see evidence of a turn. Norwegian oil giant Equinor, formerly known as Statoil, recently authorized a major new oil project in the icy waters off the nation's coast. And ExxonMobil recently authorized a massive new deepwater project in Guyana, a small nation in the northeastern part of South America. However, the world's largest oil producers know they're playing catch-up. A massive new round of spending on major oil developments is absolutely crucial to maintaining global oil supplies and production. This spending all adds up to a windfall for one group of energy companies, the oil services and equipment stocks. In our most recent report titled Oil Prices Lead an International Renaissance, we explain exactly how we expect this spending boom to unfold over the next 2 to 3 years. And we offer some of our top oil services and equipment stocks to buy right now. I'd like to give you access to this 19-page PDF report today. That's right. I'm offering to give it and the other reports I've mentioned in this presentation to you right now with absolutely no risk or obligation. No questions asked and yours to keep. I'm doing this today because I believe this summer is a crucial turning point for global energy markets and, in fact, the global economy. By September at the latest, I believe OPEC will have lost control of the oil market and oil prices will skyrocket. And by then, it might well be too late to profit from the trends I've discussed in this presentation. The investment window will have slammed shut. With that in mind, I'd like to help you navigate what's coming and guide you on an ongoing basis as this energy megacycle unfolds, recommending to you which stocks to buy, when and how to buy them, and just as important, how to avoid the many dangerous MLPs and energy stocks through this stage of the cycle. That's why I'm inviting you to take a risk-free trial of my premium advisory, Energy and Income Advisor. My mission in this premium service is simple: to help everyday folk profit from the coming upcycle in global energy markets and the devastating oilflation I expect over the next 18 months. My colleague Roger Conrad and I would also like to help you avoid the pitfalls and the popular losers in the market today, just as we helped our readers avoid Seadrill, Energy Transfer Partners, Enbridge Energy Partners, Emerge Energy Services, and so many more dangerous stocks over the past 4 years. With a risk-free trial to Energy and Income Advisor, you'll receive my latest research on energy markets and my best ideas on energy stocks and MLPs on an ongoing basis. And you'll be able to tap the expertise of income investing expert Roger Conrad, ranked #1 in long-term risk-adjusted returns by the Holbert Financial Digest. This is the exclusive place to receive our research and recommendations on energy markets. Our twice monthly issues and model portfolios are not available anywhere else in the world at any price. Once you agree to a risk-free trial of Energy and Income Advisor, I'll grant you immediate access to all 5 of the special premium research reports I've mentioned in this presentation today. And you'll also gain access to our twice monthly research reports and our model portfolios offering different allocations for investors interested in income, growth, aggressive and more conservative investments. And what if I told you that you could ask me and/or Roger Conrad any question you like about oil and natural gas prices, specific energy stocks and MLPs, the broader stock market, and the economy. Ask us any question you like and have those questions answered immediately. That's exactly what we do each month in our online chats with subscribers. Roger and I remain online for as long as it takes to make sure your questions are answered. To my knowledge, we're the only research firm that offers this level of service, and our monthly chats have quickly grown to become the most popular feature of our service. We have another monthly online chat coming up in late July, and I'd like you to join us. Once you agree to accept my invitation to a risk-free trial of our exclusive premium service, I'll make sure your name is on the list for the chat later on this month. Normally, risk-free trial members of our Energy and Income Advisor service have 30 days to try our service. Cancel your membership in the first 30 days, and we offer a 100% money-back guarantee. However, we're so convinced it's the best buying opportunity in the energy patch in years, we've decided to extend our trial subscription offer to a full 60 days. Click the Start Your Risk-Free Trial button below and sign up for an Energy and Income Advisor at our discounted charter rate of $649 per year or $194 per quarter. Download all the reports and research I've covered in this presentation. Check out our monthly model portfolios and attend our monthly online chats to have your questions answered, and only then decide. If you don't feel Energy and Income Advisor is worth every dime of the subscription price, cancel in the first 60 days. Keep any research reports you've downloaded with my compliments, and I'll immediately issue you a full refund with no questions asked and no hard feelings. I guarantee it. And I have one more special bonus for those who take me up on this trial offer over the next few days. It's a $500 value I'm offering free of charge for new risk-free annual trial members to Energy and Income Advisor. A 1/4 trial subscription to our popular deep dive investing research service. Listen, the current bull market is already more than 9 years old. It's already the second longest economic expansion and bull market in U.S. financial history. And we're beginning to see signs this rally is entering its final stages. The bad news, the average U.S. bear market wipes out about 1/3 of the value of the S&P 500. And the S&P 500 today is more expensive than it's been in 97.7% of all months since January 1881. In short, we believe the coming bear market cycle could be worse, much worse than average, as market valuations, stretched due to years of easy money, fall back to earth. The good news, you do not have to just sit back and endure another painful bear market. In our deep dive investing service, we've developed a 10-point bear market checklist that can help keep you invested in stocks to maximize gains through the current bull market, and it can help warn you about an impending market top before it's too late. In short, I believe deep dive investing is a perfect complement to Energy and Income Advisor, and if you accept my trial subscription offer today, I'd like to sign you up for a 1/4 of deep dive investing absolutely free of charge. However, I must warn you that I can't keep this offer open for long, as I just can't justify giving access to 2 of our most popular advisories at such a deeply discounted price forever. Moreover, as I mentioned, I believe Saudi Arabia and the rest of OPEC are already losing control of global oil prices. Some of my recommendations are already on the move, and history shows that the best gains in a late cycle energy bull market happen in the first 1/4 or 2. So you could say that many of my current recommendations have a shelf life before it's going to be too late to take advantage of the trends I've covered in this presentation today. So when the timer on this website ticks down to 0, I'll be closing this offer down, including the free 1/4 membership to our deep dive investing advisory. I sincerely hope you'll join us today. I've given you my very best price offer and a risk nothing and keep everything guarantee. That means you have 0 risk joining us today. To get started, simply click the Start Your Risk-Free Trial button on this page. Thanks for listening, and I look forward to welcoming you to Energy and Income Advisor in the next few minutes. Here's to your wealth. To get started, simply click the Start Your Risk-Free Trial button on this webpage.